Welcome back, and in this lesson I want to talk about the next type of indicators, and these are the oscillators. So you have a whole list of different oscillators here, and basically let's do the relative strength index first. Actually, I will just adjust it so it's a little bit more presentable. Yeah, that's pretty visible. So the way it works is you have two zones. At the 30 level, you have an oversold level, and this can be 30, can be 25, can be 20, however you decide to customize it. But it's an oversold level. So basically, the way it works is that once the price goes below this, then expect a reversal that the price is going to go back up because it's oversold. So it's a time to buy. So if we bought here, we would have been profitable. Let's see, the next breakthrough happened here. So if we bought around this level, wouldn't have been great, but the price sort of bounced up. Now we have the 70 level, which is the oversold level. So it can be 70, 75, 80, depending on the price chart and depending how you customize it. So basically, when the price goes above or touches this line or crosses this line, it's in overbought territory, and it means it's time to sell. So here it was the RSI was touching the line, so it was a time to sell. So if we did sell here, we would have been profitable. Next time it touched the line here and here. Well, if we entered around about this level, the price did fall down. The thing with oscillators is that they work really great in a consolidation market. So if you have the price which is moving from between two particular zones, it's not trending anywhere, it's in a consolidation, then these oscillators, they actually work quite fine. When the market is not trending, then trend indicators do not work, but oscillators do work. However, when the market starts trending, well, then trend indicators work, but the oscillators, they fall apart completely. Probably there wasn't enough movement here for trading. So when the RSI line is just between the lines, just forget about trading because the price is going nowhere. And then the price started trending. And here's actually a good example where this indicator falls apart, in that here we had a touch of the indicator. So a brief crossover, it could have been a chance to buy, but the thing is, market was trending downwards, so it would have been a loss. Actually, let me rewind this. Okay, here's a good example. The indicator crossed below the 30 level line here, giving us an entry point, say around about here or here. Now, if we did enter, we would have made a lot of many pips profit, and it would have been a good trade. Then the market started trending downwards, and we got a signal here to enter. It was a fake signal, we would have lost, but then the second signal to enter we got here, and if we entered it, again, we would have been quite profitable. So this is the RSI. Let me show you another oscillator. The stochastic oscillator. Actually, not my favorite oscillator, and I don't use it, but I think you should be aware of it. I'll just adjust this to make it a little bit more user-friendly. So in this indicator, you have an overbought zone and an oversold zone. So basically, when the line crosses below, it means it's overbought, and then when there's a crossover between the two lines, here it's a chance to, in this particular case, to buy. So if you bought here, it would not have been a brilliant trade, especially since it immediately had a pullback. And then when the line goes above the 80 level and there's a crossover, it means it's a chance to sell. But as you can see, here would have been a bad chance to sell. Here would have been, well, not brilliant as well, depends on your stop loss. Here actually would have been a excellent opportunity to sell because you would have made a lot of profit. But the thing that you can do with this particular indicator is you can play around with the parameters. So I will just set it up a little bit longer time periods, And now the indicator looks a little bit better because it doesn't have so many movements. Now I could tweak it even further, and I suggest that you do. For a longer time frame, it actually looks much better. I don't like when there are too many oscillations because it's not too much clear, but this is an indicator that it works really well in a consolidation market. So we would have a nice entry signal here. We would have another nice entry signal here. Here as well, depending on where you would place your stop loss, there was a good prediction. Here we got a sell signal, which price kept continuing up, but the second sell signal was actually quite good. So as you can see, based on this chart, I slightly adjusted the settings for the stochastic oscillator, and now it looks a little bit much nicer, and I would say the signal that it gives you are more dependable. But on its own, I wouldn't use this signal. If you're planning to use it, it's best to combine it with another signal. So for example, you use this as your primary signal, and then you have another indicator, which is your secondary confirmation, which hopefully it would keep you out of trades like this one, for example, where the price kept on going up, and maybe the second confirmation would say, okay, it's time to sell here. When you are setting up these types of charts and using technical analysis, it's best to actually combine the indicators to figure out a combination of a trending indicator, an oscillator, the combination that works best for you, that you're comfortable using and gives you the greater chances of success when you are trading. And I will show you another popular oscillator. It's called MACD or MACD, and it actually stands for Moving Average Convergence Divergence. And this is the default MACD indicator, but I think I have another one here. I don't have the indicator here, so what I'll do is I'll pause the video and I will download it. Welcome back. So I downloaded it, added it to the MetaTrader 4 indicator folder, and refreshed my indicators. So now it is available in my platform. And this one looks much better. So I'll delete this indicator. This one I'll delete as well. And this one I will format so that it's a little bit more user-friendly or friendly to the eyes. So this is the moving average convergence divergence indicator, and the way that it works is when the two lines cross over, it's a time to enter a position. So if the lines cross over below the middle line, you have a zero line here. If they cross over below the zero line, it's a chance to enter, to go long. And as you can see, this indicator would have been good over here. Now, when the lines cross over above the zero line, it means it's a chance to go short and to sell. Here, it would not have worked for us, but the crossover here was actually quite decent, and we would, if we caught this trade, we would have made a nice profit. Then we have another crossover here, which means we would have traded very, very nicely. So again, this is an oscillator, and basically you have a zero line. So if it crosses below the zero line, it's a chance to enter. If it crosses above the zero line, it's a chance to sell. Works very, very good in consolidation markets. Here we have a downtrending market, and these signals were again actually quite solid. So one of the strategies that you could adjust is that you could just wait for the crossover to happen, even if it's actually a trending market. Here's a sales signal. At first it wasn't all that great, but then we got another sell signal here. Eventually it went to our favor. Now there was a turn of tides, I would say, and we have a buy signal here. Let's see what would have happened if we bought it here. So it was a fake signal, and we would have lost. But one thing that you could do is, well, actually what I highly recommend is you never use one indicator on its own. You need to use another indicator. Now the MACD, it is an oscillator. So what you can do to determine the trend, for example, is again, you could add a moving average. And basically, if the price is below the moving average, it means it's a downtrend, so the market is trending, and you could take all of the sell signals using an oscillator. So in this particular example, here you have a sell signal, Here you have another sell signal, here's another sell signal, here's another sell signal. So because the price is below the moving average, you know it's a downtrend, so you just ignore all the buy signals that you get, and you get quite a few buy signals here, just take the sell signals. And that's another strategy that you could test out and see perhaps it works for you.